Ever heard of a crisis that costs American taxpayers a staggering $160 billion? That's more than the entire Apollo program that put a man on the moon, adjusted for inflation. It wasn't a war or a natural disaster. It was a financial meltdown called the savings and loan crisis, and it nearly brought the American dream of homeownership to its knees. If you're under 40, you might not even know what it was, but for a whole generation it was a terrifying front-page story that defined an entire era. So, what exactly happened? How did hundreds of seemingly safe local banks suddenly go belly up, and why did you, the taxpayer, have to foot the bill? Stick around, because this is a story of greed, deregulation, and outright fraud that holds powerful lessons for us even today. Let's rewind the clock. For decades, institutions called savings and loans, or SNLs, were the quiet, dependable cornerstones of American communities. Their job was simple and noble. They took in local deposits from regular folks and used that money to give out mortgages so other regular folks could buy homes. They were heavily regulated, which meant they were safe, but also a bit boring. They weren't making Wall Street-style profits, but they were the bedrock of the housing market. By the late 1970s, however, things started to change. America was hit with something called stagflation, high inflation, and slow economic growth. Suddenly, the fixed, low-interest rates SNLs were allowed to offer on savings accounts couldn't compete. People started pulling their money out and putting it into new money market funds that offered much better returns. The SNLs were bleeding cash. They were stuck holding old low-interest mortgages while having to pay higher rates to attract any deposits at all. They were caught in a trap, and lawmakers in Washington felt they had to do something. Their solution: deregulation. In the early 1980s, Congress passed new laws that unshackled the SNLs. The idea was to let them compete with bigger banks. Suddenly, these small, community-focused institutions could do a lot more than just home loans. They could now make commercial real estate loans, invest in junk bonds, and chase all sorts of high-risk, high-reward ventures. On paper, it was meant to help them survive. In reality, it was like giving the keys to a Formula One race car to a student driver who only ever practiced in a parking lot. These SNL managers were experts in 30-year fixed-rate mortgages, not in speculative real estate deals in faraway states or complex corporate finance. The guardrails were gone, but the experience and expertise weren't there to navigate the new, dangerous landscape. And to make matters worse, another crucial piece of the puzzle was added. The government increased federal deposit insurance from $40,000 to $100,000 per account. This meant that even if an SNL made incredibly risky bets and failed, the depositors wouldn't lose their money. The federal government guaranteed it. This created a huge problem known as moral hazard. SNL owners could gamble with other people's money, knowing that if they won, they'd get rich. If they lost, the taxpayers would cover the losses. It was a heads-I-win, tails-I-lose situation. And as you can imagine, many were more than willing to play that game. With the floodgates open, a tidal wave of risky behavior swept through the industry. Some SNL executives were simply incompetent, throwing money at bad projects they didn't understand. They went on a lending spree, financing speculative office buildings in already saturated markets, questionable condominium projects, and even windmills. But a significant part of the crisis wasn't just incompetence, it was outright, deliberate fraud. This is where the story gets truly wild. The economist and former regulator William K. Black literally wrote the book on this, and its title says it all. The best way to rob a bank is to own one. He explains how a new breed of crooked owners took over S&Ls and used them as their personal piggy banks. They engaged in what was called control fraud, where the people at the very top orchestrate the looting. They would make loans to themselves or their cronies for non-existent projects, using fake appraisals to justify enormous sums of money. They'd pay themselves huge bonuses and salaries, all while driving the institution into the ground. A classic example was Lincoln's Savings and Loan, run by a man named Charles Keating. He used depositor money to make incredibly risky investments, lived a life of extreme luxury, and even tried to influence politicians to keep regulators off his back. His institution's failure alone cost taxpayers over $3 billion. And he wasn't alone. Across the country, from Texas to California, SNLs were being systematically plundered from the inside. They were essentially zombie institutions, insolvent, but kept alive on paper through accounting tricks, all while the losses mounted day by day. For a while, the booming economy of the mid-80s helped hide the rot, but when the commercial real estate market crashed in the late 1980s, the house of cards came tumbling down. All those speculative loans went bad. S&Ls started failing, not one by one, but by the dozens, then by the hundreds. The problem was far too big for the agency that was supposed to handle it. The Federal Savings and Loan Insurance Corporation, or FSLIC, it quickly went bankrupt trying to pay out all the insured deposits. The crisis dominated the news. Every night, Americans would see reports of another SNL collapsing, of federal agents seizing records, and of once powerful executives being led away in handcuffs. It created a genuine sense of panic. These weren't distant Wall Street firms. These were local institutions where people saved their life's earnings. The entire system that underpinned the American dream of homeownership seemed to be on the verge of collapse. The government had no choice but to step in and engineer a massive, unprecedented bailout. In 1989, President George H.W. Bush signed the Financial Institutions Reform, Recovery, and Enforcement Act. It was a massive piece of legislation designed to clean up the mess. The law created a new government agency, the Resolution Trust Corporation, or RTC. The RTC's job was grim but necessary: to take over the hundreds of failed S&Ls, manage their assets, and sell them off. It became the world's largest real estate broker and debt collector overnight. The RTC had to liquidate a mind-boggling portfolio of assets, everything from half-finished skyscrapers and empty shopping malls to golf courses, corporate jets, and even a collection of antique cars. They did this while also prosecuting the fraudsters. Over 1,000 S&L executives were convicted of felonies for their roles in the crisis. It was a massive, costly, and painful cleanup. The final bill, as we mentioned, was about $160 billion, with $124 billion of that coming directly from taxpayers. For a generation of Americans, the S&L crisis was a brutal lesson in how deregulation without strong oversight can lead to disaster, and how greed in the boardroom can end up costing everyone on Main Street. So, what are the lessons here? First, regulation matters. The S&L crisis is a textbook example of what happens when you remove safeguards without understanding the consequences. Weak oversight and a get-rich-quick mentality created a perfect storm for abuse. Second, incentives are powerful. The combination of deposit insurance and risky investment powers created a perverse incentive for S&L owners to gamble, knowing they were playing with house money, the taxpayers' money. Finally, the story shows us that financial crises are rarely just about numbers on a spreadsheet. They are about people, communities, and trust. The S&L crisis eroded public trust in financial institutions and the government's ability to regulate them. It's a story that echoes in later financial meltdowns, like the one in 2008. Understanding this piece of history isn't just an academic exercise. It's a reminder that a healthy financial system requires a delicate balance of freedom and responsibility, and that when that balance is lost, the consequences can be devastating for everyone. It's a crucial chapter in our economic history that we forget at our own peril. Thanks so much for watching. What do you think are the most important lessons from the S&L crisis? Let me know in the comments below. And if you found this video interesting, please hit that like button and subscribe for more deep dives into the events that shaped our world. See you next time.